Our conversation with Lyle Stein. He's president of Forvest Global Management, for more on the real cost of money. You always bring us great stuff on interest rates, which is something you've been studying for years and years throughout your career. People believe that interest rates are on the way down, and so the cost of borrowing will go down. But you've got some information that counters that narrative.
Well, there's two pieces to an interest rate, as you know. There is inflation. You're lending money, you want to get at least your inflation dollars back. Plus, you want to earn what's called a real return, or the true cost of interest. The cost of giving up that money today, not spending it today for anticipated return a year, 2, 5, 10, whatever. The real cost of money has gone up. And the concern we have, and the concern I think the world has, is that real cost of money will continue to go up as governments continue to seek to fund their deficits through borrowing. If you look at the global financial crisis, prior to that, the real interest rate, the true cost of borrowing, was 2.5%. Mm-hmm. It fell to zero. It got negative during the post-global financial, and then in particular during the pandemic period. And you can see that on this chart.
Explain exactly what we're seeing here.
So this is the yield on U.S. inflation index securities. Again, right at the beginning, we talked about the inflation component, the real cost of money. The real cost of money, you can see 2%. If you go back 5,000 years, I don't know what inflation is average, but 5% has been the interest rate. People talk about a 5% yield, inflation 3, 2% real. That's 5. That's kind of the number that I think is not bad. Interest rate normalization is with us. The concern that we have, though, is that run-up, the dramatic run-up from negative to 2% could go higher as the U.S. Treasury borrowing $2 trillion to fund deficits, put on Canada, put on the rest of the world. There's a lot of money that needs to be borrowed, and everybody wants borrowing money. The cost of money goes up. That trend could continue, offsetting any improvements in inflation. So we'll get a CPI this week, and people are hoping, oh, it's going to be lower, lower, lower. But what will that do to the real cost of borrowing as that amount of borrowing keeps growing?
Is there a read-through to equities, to the stock market?
Cost of capital goes up, asset values go down.
Right.
That's the tough part. So as these real returns get higher, it's economic pain. How do you avoid that? Well, maybe more towards a dividend, but your long-term rate of return assumptions have to be trimmed as that real cost of money goes up. So it will have an impact. Is it day to day? Is it month to month? That's a tough one. But as an investor, your cost of money is now higher. There's more places to go with it. It's hard seeing the names that have won continuing.
Is there any potential for instance, the U.S. election to change the calculus here?
That's the struggle that we have. When you think about it, both Biden and Trump are talking about nothing to address Social Security and Medicare.
Right.
That's what's driving this U.S. deficit. You've got interest charges now above defense charges. And it's hard to see in this political environment we're in, geopolitical in particular, defense spending going down. So there's all this call on money. And where's it going to come from? It's either the bond market or cut programs, and no governments will cut programs.
You mentioned dividend stocks briefly. Talk more about what this environment means to dividend payers.
Dividend payers are now yielding something above, in many cases, that 10-year bond yield. That gives you some protection. Plus, you have the ability to grow. So, as we've talked for over many, many years, we've avoided bonds, by and large. Licenses to lose money, not fixed income, they're fixed loss securities. That trend won't go away as real interest rates rise. But dividends coming from growing companies give you a fighting chance because of the level, but you also have growth. So there's a better return available to you from equities than there would be from traditional fixed.
What about growth stocks, like the technology stocks, which investors buy because they increase their sales and profit, and hopefully their share prices at far greater than average rates?
And they are more vulnerable to higher interest rates, particularly high interest rate, real interest rates, as we saw back in 23 when we had the tech stocks sell off quite dramatically. That was as a result of rising interest rates, and a big chunk of that rise was the real cost of money going up. So there is more exposure there. Give us a 15 to 18 multiple stock that's paying a nice yield with some growth. There's reasonable safety, and you don't have what I would say the accident of a PE multiple contraction.
That's Lyle Stein, and what the real cost of